You ever hear an idea that sounds helpful on the surface, but your gut says, wait, that can't be right? That's kind of what popped into my head when I saw headlines about the 50-year mortgage being floated again. This time, straight out of Donald Trump's camp, with his housing director calling it a game changer. Now, on paper, sure, a longer loan means smaller payments and the possibility of home ownership going to younger buyers. Who wouldn't want that? But here's the thing, this isn't the first time America's tried to fix homeownership by changing the map instead of the market. Back in the 1930s, we created the 30-year mortgage during the Great Depression, and that move did change everything. It rescued homeowners who were losing their homes every few years under those brutal 5-year 50% down balloon loans. It built the middle class. It fueled the suburbs. It made owning a home possible for millions of families. But here's what's different today. 1930s, that was a credit crisis. We're now in an affordability crisis. Back then, the problem was nobody could get a loan. Today is they just can't afford the house. The 30-year mortgage solved a broken credit system. The 50-year mortgage, it's trying to patch a broken housing market, one where the average first-time buyer is 40 years old. Nearly 75% of households can't afford a median-priced new home, and you'd be paying on that loan until you're 90 years old. So before we call this a game changer, let's look back at the last time America stretched its mortgage timeline and ask the question, did that move build wealth or just buy more time? Because the truth is, the 30-year mortgage helped build the American dream. The 50-year mortgage, well, the big question now is whether it extends that dream or quietly rewrites it. So let's rewind about 90 years, back to the 1930s. American housing market was a complete mess. Picture this. Most people had 5-year loans. They had to put half the purchase price down. And when that loan came due, they owed one giant balloon payment. There was no amortization, no safety net. If you couldn't pay, the bank took your house. And during the Great Depression, that's exactly what happened. By 1933, almost a quarter of all home loans were in default. Foreclosures were everywhere. People weren't losing their jobs and their homes because of bad choices. The lending system itself was broken. Then comes FDR and the New Deal. Washington stepped in with 3 major moves that changed the entire housing landscape. The first was the Homeowners Loan Corporation, HOLC. This agency started refinancing those short-term, high-risk loans into longer fixed-rate loans people could actually pay off over time. Then there was the Federal Housing Administration, otherwise known as FHA. It insured loans so banks could lend confidently without fearing total loss if someone defaulted. Then came Fannie Mae, created to buy up those FHA-backed loans, giving lenders the way to free up capital and lend again. That trifecta created something the country had never seen before: the 30-year fixed-rate, fully amortized mortgage, a predictable, stable way to build equity and eventually own your home outright. And it worked. In 1940, home ownership sat at just 43%. By 1960, it was over 61%. That's not just a statistic, that's the foundation of the American middle class being built in real time. Developers built millions of new homes, wages were rising 3 to 4% a year, and families were finally able to buy with 5% down, not 50%. The 30-year mortgage didn't just make homes affordable, it made homeownership achievable. It turned a nation of renters into a nation of owners. But, and this is an important distinction, that success wasn't just because we extended the loan term. It was because the economy was expanding, wages were growing, and the housing supply exploded. We didn't stretch the debt to fit the dream, we expanded the economy to meet it. Fast forward to today, and here's what's wild. We actually have the opposite problem we had in the 1930s. Back then, nobody could get a loan. Now, most people can, but almost nobody can afford the house. We don't have a credit crisis anymore. We have an affordability crisis. Here's what that looks like in real numbers. The median home price in the US is just over $410,000. The median household income is about $83,000. That means the average family is spending nearly 40% on housing, far above the 28% that's considered healthy. And if you're a first-time buyer, you're up against the steepest wall we've ever seen. The average age of the first-time homebuyer is now 40 years old. That's up from 33 just 5 years ago. And get this, only about 21% of the buyers today are first-timers. That's the lowest on record ever. So when you hear people say young buyers can't catch a break, it's not an exaggeration. It's just simple math. And it's not just prices, it's supply. We're short by somewhere between 3.8 to 4.7 million homes nationally. 3 out of every 4 urban lots are zoned for single-family use only. So even when demand is there, builders can't build fast enough to meet it. Meanwhile, there's what's called the lock-in effect. Millions of homeowners who bought or refinanced when rates were 3% are sitting tight. They don't want to trade a $2,000 payment for a $3,000 payment, even if they want to move. So the inventory's frozen. Turnover is at a 30-year low, and everyone's stuck in place. That's the problem policymakers are trying to solve. And the 50-year mortgage, at least in theory, sounds like a quick fix. Stretch out the term, drop the payment, and suddenly people can qualify again. But that's not a fix to affordability. That's just rearranging the math on the same shortage. The 1930s problem was access to credit. The 2020s problem is access to housing. You can't stretch your way out of that. So let's talk about what a 50-year mortgage actually is, because at first glance, it sounds simple enough. You stretch out the payments and the monthly costs drop, and suddenly more people can qualify for homes. In theory, that sounds like a good thing, right? Well, here's the math. Let's say you buy a $400,000 home. You put 20% down, so your loan's $320,000. If you take a 30-year mortgage at 6.5%, your monthly payment for principal and interest is around $2,023. And by the time you're done, you've paid roughly about $408,000 in interest. Now, same house, same loan, same rates, but stretch that out over 50 years, your payment drops to about $1,800 a month. That's roughly $219 less per month. Not bad, right? Until you see the rest of the line. Over those 5 decades, you'll pay about $762,000 in interest. So yes, you saved about $219 a month, but you'll spend $354,000 more over the life of the loan. That's like saving $1 today to spend $2 tomorrow. And here's where it gets even trickier. Lenders won't offer that same 6.5% rate for a 50-year loan. They'll likely charge a premium, maybe 0.5% higher, because holding a loan that long ties up capital, it carries more risk. At 7%, your affordable 50-year mortgage starts looking a lot like an expensive 30-year loan with worse equity growth. And remember, the average homeowner doesn't even keep their mortgage for 50 years. They sell or refinance after about 12 years. So in practice, that means the borrower gets the smaller monthly payment benefit, but never actually gets the part where they build equity. And by year 10, the 30-year borrower has down about 16% of their loan. In the 50-year, only about 3%. At that pace, you could be paying on your home for a decade and still almost the entire original balance. So when you hear 50-year mortgage, don't think half a century of stability, think half a century of payments. Now, before we start throwing tomatoes at this thing, let's be fair. There are some legitimate reasons people are pushing for a 50-year mortgage. And on paper, it's not crazy, it's just incomplete. First is affordability relief. For a lot of buyers, especially younger ones or families with student loans, that extra 10 or 11% drop in the payment could be the difference between qualifying or getting rejected. Right now, most lenders cap your debt to income ratio at around 43%. If your payment is just a couple $100 too high, you're out. A 50-year mortgage nudges that number back into reach for some. So yes, it opens the door for some buyers who've been locked out. Second, it provides access. This isn't about luxury homes, it's about the entry-level buyers. A 40-year-old couple with a decent credit, stable income might finally be able to qualify for a $315,000 home instead of being stuck renting forever. It's not glamorous, but it's an entry point. And if we're being honest, some equity, even slow equity, is still better than none. Then there's flexibility. Proponents argue you don't have to keep the loan for the full 50 years. You can always pay it faster if your income rises, refinancing it if the rates drop. In a sense, it's a temporary bridge to get people into the market, not necessarily a life sentence. It can also give families breathing room. That smaller payment can help them build an emergency fund, save for college, or simply have a bit of cushion when life happens. In a time when so many households are living paycheck to paycheck, that's not nothing. And finally, investors love it. A lower payment means higher cash flow from rentals. For landlords or small investors, the math makes sense. Less monthly outflow, same rental income, more margin. From a business standpoint, it's an efficiency play. So yeah, if your goal is simply to make housing payments more manageable, it does that. It lowers the barrier to entry, gives people flexibility, and keeps the American dream alive on paper. But, and here's the important part, the same reason it looks so good at first glance is also why it can get dangerous really fast. Because sometimes making something easier to buy doesn't make it better to own. All right, now let's flip the coin, because for every game changer headline, there's a small print reality buried underneath it. And this one, it's a doozy. The first problem is simple math. The lifetime cost on that same $400,000 home we used earlier, the 30-year borrower pays about $408,000 in interest. The 50-year borrower will pay something like $762,000. That's an extra $354,000, nearly doubling the interest cost. So you're not saving money, you're just renting the money for longer. And when you think of it that way, it starts to sound less like homeownership access and more like lifetime debt service. Perhaps this is what they really meant when they said you won't own anything by 2030 and like it. Kind of makes you think. Next is equity. With a 30-year mortgage, by year 10, you pay down about 16% of the loan. On a 50-year, you pay down about 3%. That's barely enough to cover closing costs. This structure could create what economists call the lock-in 2.0. Because if you're not building equity, you can't move up. You can't relocate for a job. You can't refinance easily because your balance is still too high. You're stuck. So then there's the inflation trap. The idea that, hey, your payment will feel smaller over time as your income rises. But that assumes incomes actually do rise, and that inflation doesn't eat up everything else first. In reality, stretching that loan term could make borrowers more sensitive to shocks, layoffs, health issues, or even small rate changes when they try to refinance down the road. And finally, the big one, the market distortion. When you give buyers the ability to borrow more, extending the terms, sellers just raise their prices to match it. We saw this exact pattern with adjustable rate mortgages in the 2000s. More credit access, higher prices, zero net affordability improvements. So yes, the 50-year mortgage lowers payments, but it does it by trading time for wealth. Instead of a tool for stability, it becomes a treadmill. You're running, but not moving. The average first-time buyer today is 40 years old. At 50 years, that's a payoff age of 90. So unless you plan on celebrating your mortgage burning party in a nursing home, you're not paying that thing off. All right, let's line these two up side by side just to see what we're really talking about. Same house, same loan, same starting point. And here's what that means in plain English. The 30-year mortgage builds equity and it ends at a finishing line. The 50-year mortgage just moves the finish line so far away that most people never actually see it. You save a little bit each month, but that's wiped out once prices go up and property taxes rise. In the trade-off, you lose equity, pay hundreds of thousands more in interest, and carry the debt for decades beyond retirement. It's the difference between owning your home and renting your mortgage. So when you hear someone say, hey, it makes housing more affordable, the question you should ask, affordable for who? This month or for the next 50 years. When you look back at the 30-year mortgage and what it did for America, it's easy to think, well, hey, if stretching the term worked once, maybe it'll work again. But the difference is the world that made the 30-year mortgage a success doesn't exist anymore. Back in the 1940s through the 1960s, everything lined up perfectly. Wages were climbing, generally about 3 to 4% per year. Housing supply was booming. Builders were throwing up new homes as fast as they could pour foundations. Land was cheap, zoning was loose, and young families were entering their prime earning years all at once. Credit expanded, yes, but so did opportunity. That's why the 30-year mortgage worked. It wasn't just a financial product, it was part of a broader economic growth engine. We weren't just stretching debt, we were expanding prosperity. Now, fast forward to today, we're in almost the opposite situation. Wages are growing, but we still have a decade-long gap to close. Home prices rose much faster than incomes for years, and only recently has wage growth started to outpace price growth nationally. Construction is constrained. 3/4 of urban land locked behind single-family zoning. Regulations are tighter, materials are pricier, and demographics are aging. And instead of millions of households entering the market, we have millions stuck renting because inventory is frozen. So the 50-year mortgage, it's trying to recreate the success of the 1940s, but in the economy of the 2020s. And those two worlds couldn't be more different. The 30-year mortgage worked because we built our way into affordability. The 50-year mortgage tries to buy our way into it. And history tells us that never ends well. Now, here's the thing. This idea isn't uniquely American. We're not the first country to think, hey, maybe if we just stretch the mortgage long enough, everyone can afford a home. Other countries have tried it, and we can learn a lot from how those experiments played out. Take Japan. They've had 50 and 100-year mortgages since the 1970s. The logic was simple. Make payments cheaper and more people can buy. But after decades of deflation and stagnant wages, affordability didn't really improve. It just turns homes into multi-generational debt. Literally passed from parent to child. In other words, the bank never stops getting paid, even when the homeowner does. Then there's the United Kingdom. They've tested 40 and 50-year loans, mostly to help first-time buyers meet strict affordability rules. But here's what happened. The longer the term, the higher the home prices climbed. Because when buyers can afford more house on the paper, sellers, developers raise prices to meet the new ceiling. Sound familiar? It's demand-side inflation. Classic case of fixing the symptom, not the disease. Denmark and France also allow ultra-long mortgages, but their systems are built differently. In Denmark, for instance, borrowers can actually buy back their own debt at favorable market prices through a bond system, a built-in safety valve that doesn't exist in the US. We don't have that flexibility here. So once you're locked into a 50-year mortgage, you're locked in, period. And politically, it's split right down the middle. Trump's FHFA director, Bill Pulte, calls the 50-year mortgage a complete game changer. Meanwhile, even some of his own allies, like Marjorie Taylor Greene, have come out swinging against it, saying people will die before they ever pay off their home. Libertarian economists argue it's not a freedom tool, it's a financial mirage. Progressives say it could create a two-tier housing market where the wealthy buyers keep their 30-year loans and working-class families get stuck with the 50-year debt. But across the aisle, there's one surprising point of agreement. Almost everyone, left, right, economists, or realtor, says the same thing. The problem isn't the mortgage, it's the supply. Till we build more homes, longer loans won't solve affordability. They'll just stretch the pain out longer. All right, so what does this all really mean to you? Whether you're thinking about buying, already own, or you're just trying to make sense of it all, let's start with buyers. If the 50-year mortgage ever actually rolls out, and remember, it still faces major legal and regulatory hurdles, it might help a few people qualify. You could shave a couple $100 off your monthly payment and squeak past that debt to income limit. Now, if that's what gets you in the door and you know you'll be refinancing and moving within 10 to 15 years, it's not the end of the world, but just be honest about what it is. It's not a wealth building tool. It's a bridge loan disguised as a long-term plan. You're not buying more affordability, you're buying more time. So if you go that route, do it strategically. Keep an exit plan. Track your equity early, and when rates drop, refinance down to a shorter term as soon as you can. Now, for homeowners, if you already own a home, this could impact your equity, but probably in your favor. If 50-year loans increase demand, it could push prices up, at least in the short term. So your home's value might rise a bit, but affordability for everyone else will fall even further. In other words, good for your equity statements, bad for your kids trying to buy. And for sellers, it's a mixed bag. More buyers being able to afford payments might sound good, but remember, most of those buyers won't be building much equity. That means fewer move-up buyers down the road, fewer repeat sales, and potentially slower long-term turnover. In the short term, it boosts activity. In the long term, it could freeze the markets even more. So bottom line, if the 30-year mortgage built the American middle class, the 50-year mortgage could quietly build a debt class. It won't crash the market overnight, but it could reshape how generations think about ownership and wealth and retirements. So as a buyer, focus less on the length of the loan and more on the health of your plan. The product doesn't build wealth, the discipline does. So here's where we land. The 30-year mortgage was born out of a crisis, but it's created an opportunity. It built neighborhoods, families, and wealth for generations. It worked because it was part of a bigger plan. We didn't just stretch the debt, we built homes, we raised wages, we expanded the middle class. The 50-year mortgage, it's trying to do the first part without doing the rest. And that's the difference between a policy that builds dreams and one that just extends payments. Now, could it help a few buyers get into homes who otherwise couldn't? Sure. But in the long run, we've got to ask ourselves, do we want to solve affordability by making debt last longer or by making homes more attainable? Because when you stretch a 30-year mortgage to 50 years, you're not changing the math of ownership. You're just changing who it works for. And that's the story here. The 30-year mortgage built the middle class. The 50-year mortgage could quietly build a wall between those who own and those who never quite get there. So what do you think? Would you take a 50-year mortgage if it meant finally owning a home? Or do you think it's just another way to stretch the American dream a little thinner? Drop your thoughts in the comments. I would love to hear how this looks from your side of the table. And if you're in Illinois and you're thinking about buying or selling, or just want to make sense of where the market's headed, reach out. This is exactly the kind of stuff I help people navigate every single day. I also realize that finding a good agent is often a challenge. I work with agents in all 50 states. Just send me a quick message and I will get back to you with someone that is a good fit for you. All my contact info is in the description below. Thanks for watching and see you next time.